Hello. Welcome to today's session on year-end tax savings and strategies for Shopify e-commerce store owners. As we near the end of the year, it's time to really think about how you can maximize your tax savings by making strategic purchases and investments before December 31st. This session is going to be packed with practical tips and strategies specifically designed for e-commerce businesses like you. So let's dive in and get started. My name's Jacob Curtis. I'm a CPA, a certified profit first professional, and a business coach. And I started Curtis Accounting Solutions to remove the stress of doing the bookkeeping, payroll, and taxes, and to provide practical business advice that helps e-commerce stores really piece together financial freedom. I'd love to hear your thoughts and questions on today's episode. So please leave a comment below and remember to like, share, follow, subscribe, and all those things. Year-end tax planning is a vital strategy for all business owners, especially for Shopify and e-commerce store owners, because it helps reduce your taxable income. By making the right moves before the end of the year, you can increase deductions and even set your business up for growth in the coming year. Waiting until tax season could mean you miss out on opportunities that could save you money right now. This planning helps you to better manage your cash flow. For example, if you reduce your taxable income by $50,000 through deductions at a 24% tax rate, that's up $12,000 in tax savings right away. Now, that $12,000 can be reinvested into the business, helping you buy more inventory, improve marketing, or even hire more people. These are some of the ways that you can capture savings now and before the end of the year. One of the best tax strategies is taking advantage of the Section 179 deduction, which allows you to deduct the full purchase price of qualifying equipment or software in the year that it's bought. For 2023, that limit was $1.16 million. This is particularly helpful for Shopify store owners who need to upgrade or invest in new tools to grow their business. This deduction applies to a wide range of purchases, including machinery, office furniture, or even improvements to your Shopify setup, like upgrading your computer systems or warehouse machinery. Let's say that you purchase new packaging equipment for your fulfillment center and it costs you $80,000. Normally, you depreciate this cost over several years, but under Section 179, you can deduct the full $80,000 this year. And if you're in the 24% bracket, that's $19,200 saved in your taxes. Another example, if your Shopify business is expanding and you decide to invest $50,000 in a high-performing inventory management software in November, Section 179 allows you to deduct the full amount, again, saving you, if you're in the 24% tax bracket, about $12,000. So instead of waiting for years to claim that depreciation, you can reap that full tax benefit today. By front-loading your expenses before year end, you not only save on taxes, but also accelerate your business's efficiency. Improved productivity can lead to higher sales next year, giving you the dual benefit of tax savings and business growth. Now, another smart tax move is to defer income into the next year. If you're expecting a large payment from a customer, consider asking them to delay it until January. Don't make those calls until January. By doing this, the income tax is not taxed this year, and it potentially helps keep your tax bill lower for this year. This can particularly be useful for high-income years, and you want to smooth things out a little bit. So let's say you have a large payment of like $100,000 coming in, expected to come in right at the end of the year, December 30th. By pushing this payment to January 1st or a little bit later, you avoid adding that income in your current year tax liability, potentially saving you thousands in additional income tax, because that may push you into the higher tax bracket. So if you're currently at $180,000 in income and the next bracket starts at $182,000, receiving another $100,000 in December would push you into the higher bracket possible, adding in a significant tax burden. So just by delaying or deferring that income for a couple of days, you stay within your current bracket and saving you thousands of dollars. You'll recognize that payment in the coming year, and it will potentially save you thousands of dollars just by deferring that income. So deferring income allows you to strategically manage your cash flow and avoid tax bracket jumps. It's a powerful way to control your tax obligations, retaining more capital for reinvestment in the business for the coming year. Another option is to prepay certain business expenses. This is a very effective year-end strategy. For example, prepaying your rent, advertising fees, or utilities for the next year, a couple months for the next year, allows you to deduct those costs in the current year giving you a tax benefit in the current year. So if your store rent is $5,000 and you prepay 3 months worth of rent in December, that's going to allow you to have an additional $15,000 rent expense in December. Now, this could lower your tax bracket and potentially save you thousands of dollars again up to your 24% tax bracket and be roughly $3,600. This strategy is also useful for advertising costs. Imagine you have an ad campaign scheduled for January 24 for $10,000. By prepaying for that ad in December, again, you can deduct $10,000 now, thus reducing your taxable income. So prepaying your expenses, you lower your tax liability in the current year and keep cash flow predictable. You know you paid the cash out now, so you're not going to have to pay that rent in for the next couple of months. This is an especially useful tool for smoothing out some of those income spikes that may come along. Now, contributing to a retirement plan is one of the best long-term strategies available. As a Shopify store owner, you can use various retirement vehicles like a SEP IRA or a solo 401k or others to really lower your income while securing your financial future. You can contribute up to, I know in 2023, it was $66,000 into your SEP IRA and $22,500 into your solo 401k. For example, if your taxable income this year is $250,000, contributing $50,000 reduces your taxable income to only $200,000. That moves the brackets a little bit for you, right? If you're ending up in the 24% tax bracket, that would save you roughly $12,000 in taxes. So over time, these contributions can grow to tax deferred as well, helping you build wealth while saving on some of those taxes. By contributing to retirement plans, you gain a dual benefit. You get the tax savings now, but also financial security in the future for retirement. Plus, with compounding growth, these contributions will work for you in the long term for your retirement. Another powerful year-end strategy is writing off bad debts. Now, this is only possible for some scenarios in some situations, but if you have a customer who hasn't paid and it's clear that they won't, you can write off what they owe you as a business loss, which directly offsets your taxable income. So let's say you have a customer who owes you $7,000, but after months of trying to collect throughout the year, you realize the debt's just not going to be collected. It's become uncollectible. So you can write off $7,000 of bad debt, which will reduce your taxable income, saving you thousands of dollars. On that one alone, assuming you're in the 24% bracket, that would save you about $1,600. Writing off that debt ensures you're not taxed on income you never received. It's a key tool for reducing tax liability, especially when sales don't go quite as planned. One of the biggest tax breaks available for small businesses is the qualified business income or QBI deduction. This allows you to deduct up to 20% of your qualified business income if you own a pass-through entity like an LLC or a sole proprietor or an S corporation. So let's say that you have $100,000 in qualified business income. With that QBI deduction, you can reduce that by 20% or $20,000. If you're in the 24% tax bracket, that's a savings of $4,800. But remember, the deduction is subject to certain income thresholds. So if your income is close to the limit, you may want to reduce it using other strategies like retirement contributions or Section 179 deductions or others. The QBI deduction offers substantial tax savings, but it's important to monitor your income levels to ensure you maximize this benefit. Proper planning can really help to keep you within the qualifying range. Finally, don't forget about charitable donations. Contributions to qualified charities are tax deductible, and this is a great time of year to give back. Be sure to track all your expenses thoroughly and those donations especially. And if you have time, review last year's tax return to make sure you didn't miss any deductions or opportunities that you can apply for in this year. So if you have any questions, comments, or anything like that, if you need assistance managing your company's finances, don't hesitate to reach out to me. I'm here to help you piece together financial freedom. Schedule a call with me to get started by scanning the QR code on the screen or go to jacobcurtiscpa.com/5-strategist-calendar or just click the link in the comments below. Remember to follow me, Jacob Curtis CPA and Curtis Accounting Solutions on Facebook, Instagram, Pinterest, and YouTube. Thanks for watching, and we'll talk to you soon.